Okay, so welcome to my trading lesson. So, who is this lesson for? Well, if you are somebody completely new to the financial markets, then this is great as you will learn from this. Or maybe you trade forex and cryptocurrencies and you'd also like to get into stocks, then this is also great as this will help you as well. Or you may even be just a complete beginner and you'd like to create another source of income and beat the 2.5% inflation rate and build your wealth. So, who am I? Well, I'm the leader of Impulse Investors and I'm just taking my time to help change lives for the better. So let's get into this lesson. So I'm going to be realistic about this. Now, most of you will not obviously start with a lot of money if you are on the younger side, maybe a uni student, college student. So I've got this plan out here what I would explain for you to start with while you're trading. Now, to start trading realistically, you would probably open a practice account, and I would want you to open a practice account with a realistic amount that you would start with so you can kind of understand what profits you're making, what you're losing, and what you're getting yourself into. Now, obviously, if you start as a level 1 trader, in my opinion, you should be starting with around £100. Now, your profits won't be as much, obviously, but this is only for you to understand what trading is and get your head around it. I don't want anyone buying more than 5 shares because the more shares you have, the less you're concentrated on one, and this can obviously cause you to make silly decisions and obviously get into a loss. Now, obviously, you will have times where you lose money, and I would want you to set these daily losses that if you do hit that amount of loss in a day, you just quit and you move on to the next day, and hopefully that is better. I would also like you to set a weekly loss because what happens is if when you lose in trading, you go on a losing streak. You either go on a winning streak or you go on a losing streak. So if you limit yourself from losing that much, you can, I don't know, learn some new things and move on next week, hopefully in a profitable stage. Now, profit wise, I should recommend all of you making these numbers out of the type of deposit. Now, obviously, you can try work that out yourself, like the percentage and how much you should be making. You should also have a minimum amount of trades. So I'd recommend having 4 trades minimum, so you can at least diversify your portfolio. And you should be trying to hit these targets within 7 days. Okay, so what is the stock market? Well, the stock market is built of many exchanges where individuals and institutions can purchase shares from a publicly trading company. This is known as the stock market, obviously. So, the stock market includes stocks, options, ETFs, bonds, and mutual funds. So, when you buy a share or a stock of a company, you are basically buying a percentage ownership of that company and that people can buy and sell. Now, what an option is it's a contract that gives the buyer the option to buy the stock at a strike price and date that is set before buying. I will go into this in a bit more detail in some more upcoming videos, but because you're just going to be learning the simple trading, we wouldn't go into options because that is quite different. So, what is an ETF? Well, an ETF is an exchange traded fund. So, this is a basket of securities. For example, the S&P 500 is one, and an ETF can contain multiple stocks of different type of companies. So, for example, Apple, Microsoft, Facebook, Snapchat, and many more. So, what is a bond then? A bond is a fixed income instrument that represents a loan made by an investor to a borrower, usually corporate or governmental. Now, normally you can earn a return rate on a bond. So, per year you may earn 15% return on your bond or a 25% return on your bond, which is a good investment at it, as it is quite stable compared to fluctuating stocks. However, you have to realize that all capital is at risk when you invest. So, what is a mutual fund? Well, a mutual fund is a professionally managed investment fund that combines money from many investors to purchase securities. So, why would you invest in the stock market? Well, the average interest rate in a savings account is very low and usually well under the 2.5% yearly inflation rate, which means leaving your money in the bank, your money is basically becoming worthless every year. So by the time it's 10 years later, your money is not worth that same 10,000, it's probably worth around 6,000. You can't buy as much stuff as you can as you would have before. Your personal tax rate is another area that can have a negative effect on your money, and investing can also beat that rate. Now, as I explained before, the S&P 500 that has a yearly return rate which is on average 9.8%. which will obviously beat the inflation rate and give you a lot more profit. Investing for the longer term is a good way to obviously not risk your money to get hit by inflation, and obviously it is better to invest and save. Now obviously you might just want to build your bank account up, have the higher numbers in there, but realistically if you just invest it, you can put those numbers in it later. Now obviously the S&P 500 isn't the only ETF that can beat the inflation rate. There are quite a few other ETFs, such as ARK Invest has multiple ETFs, and so does iShares Global. So when investing, you need to realize what makes a stock go up or down. So in order for a stock to move up or down, there must be a buyer and seller. For example, you might order 100 shares of Apple at $106, but your order for those 100 shares of Apple at $106 will only be filled if a seller is selling the same amount of shares for the same amount of price. So now you might be wondering, why is the stock increasing in price? Why is it going down in price? Well, basically this is because of rumors or news. Now I've listed some news. I've listed some type of news that can affect the stocks. So obviously you have your earning reports, which is called quarterly earnings, which are given out 4 times a year. You have partnerships or separation from partnerships. This can obviously make the stock go up if the partnership is with a good company, or the separation could go down. The separation could cause the stock to go down if it does impact the business quite severely. Now dividends are something I will explain in another video, which are basically payouts from the company that you invest in, but this can also have an effect on the stock price. Now you can also have new product or product recall. Most of the time a new product would cause the stock price to go up if there is a lot of potential innovation seen in that product. However, if your product has been recalled back, this could be seen on the negative side, as there might be a fault with it which would cause the stock price to go down. So I'm just going to skip to supply and demand, where obviously if a product is given out and there's a lot of demand for that product and it helps a lot of people, well obviously the stock will go up, and vice versa. There are some things that can affect the stock as a whole. So for example, let's say another company was also affected, this can cause some other companies to be affected with it. And obviously political elections, scandals, and obviously you might know pandemics such as COVID-19, which is happening right now as I'm recording this. Change in how many people have jobs, the unemployment rate. So obviously with coronavirus happening, there have been a lot of jobs being lost, so this can cause the stock price to go down. For example, Rolls-Royce was a very strong UK share, and hence coronavirus has hit it quite hard. Unemployment rates have actually dropped in that company, and has caused the stock price to go down quite significantly. So tragedies can also cause the stock price to go down, such as 9/11 obviously. And every once in a while there will be a industry bubble. So for example, in 2009 there was a crash, and these create demand for the stock, which also pushes the stock price up, or if there's less demand, it will push the price of the stock down. So let's look at Apple stock chart since its IPO. So IPO is initial public offering. This is when a company is just released into the stock market. So the key factors of a company doing well in the long term in the stock market is essentially just how good the company is. So you have to think to yourself, does it make more money than it spends? Is there demand for the product or service, and do they please their customers, and is there innovation in this stock? So obviously you all know about the iPhone, the iPad, the MacBook, and obviously there is a lot of demand for those type of products, and they do please their customers, because obviously there are loyal customers who would want to buy the new phone every year, the new MacBook every year. And obviously there is innovation, because Apple aren't just thinking about the technology side with phones and computers. They're also now thinking about vehicles, which I would love to see how it turns out, but I can't say anything right now as I am not your financial advisor. So let's look at Apple's stock chart for the past year. So I've got a chart up here from Google, and you can see that obviously there have been some downsides during this year. So the first thing we can clearly see is that there was a very big crash around March. Now this is because of coronavirus, and a lot of people got weak hands and decided to sell because of fear. But realistically, most of these companies, these high blue chip stocks such as Apple, weren't significantly hit, because within a few weeks they were back up and running. But because the stock price had been collapsed so hard, it took a bit of time for it to make its recovery. Now the second thing we can see is right before October, there was a stock split for Apple, and there was also a tech rally in the stock market. So this is basically when all the tech stocks were actually increasing for no apparent reason, which yes has caused the crash that happened before October 2020. And obviously because there was a split, this is when Apple did divide their shares, which obviously makes the shares cheaper and more available to the public. So let's look at Apple stock for the past day as well. So this basically shows Apple's chart for one day, and usually if news is put out in that day, it will affect the next day or the current day. Now this news can obviously be bad or good, which will cause the stock price to go up or down. Now Apple has recently been going down. It was recently going down a downtrend, and is now obviously making a recovery. Now normally because Apple is such a strong company, the reason that people are just selling it, the reason that it's just going down is because people are just selling it with weak hands or just taking profits. Now obviously you can see the chart goes up and down quite frequently, and this is just because of buyers and sellers. But overall the stock did end better than it started. And obviously you can see that there's a grey line here, which is post market hours, which I will need to go into because this can actually help you predict the previous can help you predict the next day in the stock market using the previous day. So when trading, you're going to be seeing a lot of different types of stocks. Now I've wrote down the sectors of stocks there are. So obviously you have energy stocks, material stocks, industrials, consumer discretionary, consumer staples, healthcare, financials, technology, transportation, communication services, utilities, real estate, hardware, software, semiconductors, banks, insurance, and biotechnology. So obviously you might know some companies like Apple would obviously go into technology, National Express would obviously go into transportation, Pfizer would go into healthcare, maybe biotech, I'm not really sure about that, I'm gonna need to read into it. And obviously software would go into Ubisoft. Obviously there are quite more examples I can give out, but that's it. So there are different types of stocks with your market cap. So I've just separated them here. So blue chip stocks and penny stocks. Now your blue chip stocks are your more stable shares such as Apple, Microsoft, and your penny stocks are just shares below $5 realistically. So obviously you have a mega market cap stock which is over 300 billion. Now companies like Apple and Microsoft I'm pretty sure are around the 2 trillion mark, so obviously those would be mega stocks. And you do have some penny stocks such as Okugan, which is around $7, but it was a penny stock the other day. So what you gotta understand with penny stocks, they can be easily manipulated. So people can put a lot of money in them, which would cause the stock price to go up for no apparent reason. There might not even be any good news to it. It might be bad news, but if enough people put money into a penny stock, it can cause the price to go higher. So this can give a lot of people profit. So this is called a pump and dump scheme. So people obviously who buy at the bottom will be profitable, and people who buy at the top will be dumped on and obviously lose a lot of their money. So why trade stocks? Obviously I've mentioned before, beat the 2.5% inflation rate, grow your wealth, and use it as a second income. So how do we actually buy a stock? So obviously I've mentioned here that you are the buyer and seller, and you will be making a brokerage account. So the one I recommend if you're in the UK is Trading 212 because it's the most easiest to use and it has very little fees. It has no fees at all actually, but obviously there is a spread between every buying and selling, which I will explain in a later video. And obviously you have your stock exchange such as the Nasdaq, the New York Stock Exchange, and the London Stock Exchange. So what happens here is the buyer sends a buy order to the broker, and the broker then goes to the stock exchange and gets that share. The stock exchange then gives back the share to the broker, and the broker then sends back to you. And obviously if you're selling that share, vice versa. So when you're trading, you will have to learn these terms. So long. So what is this? So long is when you buy a share and when you believe it will go up. So as a stock goes from $50 to $60, you will make profit. And there is the opposite, short. If a stock goes from $50 to $40, you will make a profit because you sold the share short. Volatility. So this is another key term you will have to know. How fast the stock moves up and down. Now, penny stocks are a lot more volatile because even one candlestick, two candlestick can actually cause a big 10% increase, 20% increase. However, with blue chip stocks, one candlestick might only be not even a percent up. So volume. So what is volume? The number of shares being traded in one day. So obviously, when you're making your charts, you will have a volume tick volume at the bottom, and if you put your cursor over it, you can actually see how many trades are done in that time frame. So obviously, if you have a 1 minute time frame, you will see that this many shares have been traded in that 1 minute. Or if you have a 5 minute time frame, you'll be told how many trades are done in that time frame as well. So bullish market and bearish market. So a bullish market is when the prices of a stock is meant to go up, and bearish is a time when the stock price is meant to go down. You also have ask and bid. Lowest price a seller will sell for, and the highest price a buyer will pay for. These won't really come into your trading like quite early on, but this is a good thing to know. So it hasn't actually been now 16 minutes since I've started recording this, and I will probably make another video, part 2, which will explain everything as time goes on. So this is the first lesson that I will be giving to you guys. So thanks for watching. Yeah, so just make sure you watch part 2, and that's it for me.